Welcome to part 2 of our free commodity course offered at Commodity Advisor. In this section, we will discuss the risk of loss that can occur while trading commodities, the selection of a commodity broker, and some financial considerations everyone should consider as they fund their commodity account. We remind those who review this course material that there is substantial risk of loss while trading the commodity markets. In fact, this lesson is going to discuss some of these risks more thoroughly. As always, all discussions of performance are entirely hypothetical. We never discuss real trading results of an actual account for compliance reasons. What are the risks to commodity trading? Well, you might say, John, I could lose my, shall we say, assets. Well, that's true, but I want to show you it's not because commodities are more volatile than stocks. There is a difference between the two, but it's not volatility. Commodities are not more volatile than stocks. That is, if you compare the change of price from today to day in terms of percentage change in price. Actually, if you look at commodities and stocks and look at the percentage daily change, the two are very similar. No, it is the use of margin that makes the public think that commodities are more volatile. Let me show you an example. You see a chart of crude oil for the summer of 2007. Now that squiggly line below the prices is the daily change of crude oil from one day to the next in terms of percent of change of price. As you can see, most of the daily percent changes range between 1 and 3% a day. Now look at the chart of Apple stock for the same time period. Note how the daily change in price in percent was actually higher than the crude oil. In terms of daily percent change in price, Apple was more volatile than crude oil during this same period. Here's a real sleeper stock, General Electric. Well, look at the percent change per day. Its daily change in price in terms of percent is just as high as the crude oil chart that we've seen previously. Now, I have to admit something to you. I prepared these slides in advance because this is what is normal. Now it's early January 2009, and sure enough, I've got to get you up to date about the recent changes in the commodities. What's actually happened in late 2008 is that we've seen a recent change in the actual trading and discussion of commodity volatility late in 2008. And let me give you an example. In late 2008, crude oil and a few other commodities have substantially increased their daily change in price in terms of percent change per day. This is because of the extra low prices that many of these commodities have seen during this period. And as you can imagine, when you add the increased volatility of the uncertain financial times, you get a rise in volatility, and this lately, in the late part of 2008, has fed into an increase in volatility in terms of percent change per day. So there it is. There has been indeed in late 2008 a substantial rise in many commodities in its daily change of price, even when you look at it in terms of percent change per day. But I've got some news for you. This same event is also true for some stocks during this same time period. Here I show you Google as an example. Commodities can be volatile and they can be risky investments, but this increased risk is not just because you open up a commodity account. Commodities then and by themselves are not extra volatile. Some stocks are, some commodities are, but as a general theme, commodities are not more volatile than stocks on a daily basis if you look at the average change and percentage change on a daily basis. Commodities are not more volatile because of volatility alone. Commodities are more risky to the average investor because the commodity broker and futures exchange will allow its customers to control a large dollar amount of commodity contracts with a small portion of original deposit, or what the industry calls original margin. For example, there are times when a margin of $5,000 can buy or sell a $100,000 valued futures contract. It is this leverage, this 20 to 1 in my example, that creates the additional risk in a commodity account. Now imagine if you traded your stock account with this same degree of leverage. You would see the same volatility and the same potential for loss. But you cannot do that in your stock account. Even pattern day traders are allowed only a 4 to 1 use of margin. And if you carry your positions overnight, you only have a 2 to 1 margin, or let's call it leverage, for your stock account. No, it is the use of this leverage in a commodity account that creates the increase of volatility and creates the increased risk for the average commodity trader. Now let's talk about properly funding a commodity account and understanding the risk of loss. Every trader has losing periods of trading. No matter how good you may be as a trader, you will have several consecutive losses from time to time. It is a mathematical certainty. How does the professional trader survive these periods? Well, there's two ways. One is to fund the account to a size that can handle the financial drawdowns or losses that are most certainly to appear. Two, you do not risk too much of your capital in any single trade. Now, on the first point, if you fund your account at the minimum margin requirements and you pick trades casually, kind of like a spin at the roulette wheel, well, guess what? You're probably going to have the same results for everyone else leaving Las Vegas. Now, saying that, there are some investors who trade a little different. They do invest in the commodity markets with a special circumstance. This may be a circumstance such as wanting to take advantage of seasonal trades that they think are possible, or perhaps they can use margin for the purchase of options. And this is another way that some traders limit their loss through the use of buying call options or buying put options. Their loss is limited to the premium that they pay for these options. But then that's a special circumstance, so that's a little different. In regards to generally trading, the conditions that I mentioned before apply. You need enough money in your account to handle drawdowns and losing periods, and by goodness sakes, do not risk too much of your account in any single trade. Alright, let's assume you're ready to take on the risk associated with trading. You're convinced that you've talked to the right people and that you think commodity trading is appropriate for your financial condition. How do we select a commodity broker? Before I discuss how to select a commodity broker, there's a couple of terms I'd like to explain. The first is FCM, Futures Commission Merchant. This is the actual firm that holds your money and clears the trades that you make for your commodity account. Now, you're charged broker fees for this clearing service. Now, as you can imagine, there are other fees connected to trading. Think of it like taxes. There's exchange fees for the contract charged by each exchange. There's a regulatory fee, and there's a floor broker fee if you happen to use a floor broker. And there's other fees where appropriate. So commissions add up all of these into your commission rate. Now, another is the IB, another term, introducing broker. This is the firm for which you're most familiar. Some brokers are self-clearing, meaning they clear the accounts and trade themselves. But most IBs actually introduce your account to an FCM. The IB is the middleman, so to speak, and he charges a commission for this service. And as I say here, it is generally the IB that provides the real service to the customer. Now, more about this later. Now let us discuss the view of a commodity broker in terms of the service that they provide. The discount broker is a broker that often just provides a trading platform to enter various commodity orders. He pats you on the back and wishes you good luck. Oh, you get cheap commissions, all right, but very little service. If you have a question about trading, don't call them. What's a condor option spread? Go get a book. Your internet goes down and you need to cancel an order? Well, you can call them, but you might be number 107 in line on hold, and that may take forever before you ever get to talk to a real live broker. Listen, my advice is this. If you're an experienced trader and you have backups to protect your account under special circumstances, you can use a discount broker. But if you are new to trading, and then you need to check around for a full service broker who is not too expensive, but one that you can trust, this additional care will serve you very well in the near future. Now, lastly, we're going to take a look at full service brokers. Now, what does this mean? First place, the commission rates are generally higher, no question, than a discount broker. But you are getting assistance, hopefully, for that increased commission cost. If you need help, a full service broker should and would generally answer your questions. They'll talk to you on the phone. They will be available to you if you have a problem. Yes, you have to pay more for that service. Now, saying that, service is the key, and they are always available to you. And these days, it's almost 24 hours that they're available. So they're putting in long hours if commodities have gone to a 24-hour day. But please remember, these guys are busy. Do not use them as a quote machine. Do not be on the back nine on the golf course and want to call them for a cotton quote if you don't have any intentions of doing a trade. So just remember, these guys are busy. They're servicing not only your account but other accounts. Saying that, that is still an important feature of the full service broker. They generally can give you information that you're definitely not going to get from a discount broker. So as you begin to make the decision of do you use a discount broker or do you get a full service broker, take a look at how experienced that you are as a trader. If you're brand new and you think that you really need some help in entering orders and understanding the commodities, understanding trading, then you may seriously consider using a full service broker. You're going to pay more in commissions, but for goodness sakes, it should pay off rather than using a discount broker who's very cheap and you find out you get zero service for that execution that you just made when you really have no idea what you just did. So just think of that. Full service brokers provide full service. Discount brokers provide no service, but they do provide very low commission rates. Alright, now this completes our second part of our free commodity course. In the third part, we're going to be beginning to look at the various ways that professional traders actually trade the commodity markets.